Hi everyone, welcome to my YouTube channel. Once again, my name is Miracle Naji and I'm an investment professional within Venture Capital. I started the series talking about deal execution, looking at all the different terms and conditions that venture capital firms will typically want to include in an investment agreement. So in my previous video, I talked about the economic terms, and in this video, I'm going to be focusing on talking about the control terms. And there are three different aspects that I'll focus on. So one is the aspect of membership of the board of directors. The second one is protective provisions, and then the third one is drag along rights. So without any further ado, let's get started. All right, welcome back. Aside from the economic considerations that VCs tend to make, the other aspect for them is about control. How are they able to have an influence on the decisions that are being made or in the company and how that tends to affect their investment position. And one way that investors are able to guard against that is to have a seat in the board of directors. And one thing you know is that board of directors is about governance. It's about steering the organization towards its long-term goals and objectives. So typically investors will want to have a seat in the board such that they're able to control certain key decisions that are going to be made. And typically the board of directors should be around 3 to 5 members, now comprising the investors, the founding team, and then any other external party that is going to be as a member of the board, just to ensure that there is proper governance, right? So always, not always, depending on the kind of investor, right, and the sort of amount of money that they are investing. So most lead investors in a particular round, because of the huge amount of capital that they are investing, they will want to have a board seat in that particular company. So that's for board of directors. Then the second one is in terms of protective provisions. Now, protective provisions are effectively like veto rights the investors have on certain key actions by the company. Now, it gives them the ability to prevent certain corporate actions that could affect their position negatively. So there are so many and tons of protective provisions that you may find that investors will want to include. Some many times they want to go creative on it, but there are just a few that I want to touch on. So the first one being protective provisions against changes in the terms of the stock owned by the VC firm. Now, this provision protects the rights and preferences that the VC has negotiated as part of their investment. Now, it protects such negotiations from any kind of sudden changes. Let's say, for instance, the startup, the investor came in at their Series A round, and then the startup is going to Series B, and they're expecting other investors, and then there are certain fundamental things that may affect the early investors that came in at Series A. So this protective provision protects them from having their the terms and conditions change significantly. So some of those terms and conditions like anti-dilution rights or liquidation preferences like we saw in the previous video. So the second one is in terms of the authorization to create more stock. Now, one thing you should know is that when more stocks are created in the company, it definitely would have dilution effect on investors. So investors sometimes we want to have that sort of protection against um, the startup founders or the management team creating new shares, creating new stocks without the consent of the investors. Right. So again, another protective provision we can also see is in terms of buyback of any common stock. Now, this prevents the company from buying back its own shares, which could reduce the VC's ownership percentage. So sometimes what certain startups do is that once they have, let's say, some excess cash or excess cash, they want to buy back some of the shares that they have issued in the past, right? So this can affect the ownership stake of the investor. So sometimes protective provision could prevent the company from doing such. Another one is in terms of issue stock or issue stock senior or equal to that of the VCs, right? Now, this prevents the company from giving other investors better rights or preferences than the VC shares. So let's say VC invests at Series A and then they are now going to Series B round and they are giving those Series B round investors certain preferences that is better off than the Series A investors. So usually some VCs will want to include that as part of their protective provision. The other protective provision is also in terms of change in the size of the board of directors. This affects the VC's representation on the board and their level of control and influence in company decision making. So many times, if you have a board seat, you have certain voting rights. So if you start increasing the board members, definitely it kind of reduces the amount of control that the VC is going to have. Right. Other protective provisions is like borrowing money. So sometimes the VC, because of the impact that certain debt can have on the financial health of the business, right? Especially for startups that many times are not generating enough operating cash flow in order to cover certain to cover the business needs and meet growth demand. So now imagine that on that very constrained cash flow already, then you're also paying to service debt. So sometimes VCs may want to have a protective provision that stops the founders from doing that. So other protective provisions include areas like declaring bankruptcy without the VC's approval and all of that. Then the last part that I'm going to be talking about and wrap it up is drag along rights. And these are rights that allow the majority shareholders to force the minority shareholders to go along with the sale of the company. Always keep at the back of your mind that investors, VCs are concerned about exiting a startup. They are concerned about getting returns on their investment. And one primary way that that sort of exit is going to happen is through acquisitions. And sometimes when there is, let's say, an acquisition on the table, sometimes certain investors or certain shareholders in the company may not be inclined towards that particular acquisition, either for so many reasons. Maybe the price is not good enough, or maybe they are looking at operating the business for, let's say, more years and possibly look out for an IPO. So the drag along right kind of allows the majority shareholders to force the other minority shareholders that perhaps don't that are not in sync with the sale to go along with the sale of the company. So these are some of the control rights that VC will want to include in an investment agreement, just to give them better control of the company. So if you found this video helpful, please hit the subscribe button, hit the like button, and also drop your comments if you want me to make any video explain any other part of the control and investment agreement terms in the future. Thank you so much.